Well, hello and welcome to the Digital Finance Analytics live session today, the 17th of July 2018. I'm Martin North, the Principal of Digital Finance Analytics, and it's my great pleasure to welcome all those on the live stream now. Quite a few up there already, getting on for 80, I think. 81, that's good. And hopefully there will be a few more watching post. So the purpose of today is to discuss the latest dynamics in the finance and property markets and specifically focus on what I've called financial resilience. Cue the screen. There you go, financial resilience. The reason I'm talking about this is because I think this is a really important aspect. And what we're going to do is essentially go through a few different dimensions over the next few minutes, probably 45 minutes to an hour, depending a little bit on what you want to talk about as well. But I've got a few things I want to present. So to get going, what I'm going to do is to go over here. Okay, so just quickly on the running order, bit of an introduction, done that. I want to talk about the house rules. I'll talk about our models just a bit. I'll highlight just in on 6 key slides, which will just set the agenda for the rest of it. And then we'll have a questions and answer session, and I'll answer pretty much anything I can. I may claim the fifth on some things. I see that people want to talk about Glass-Steagall, bail-in, etc., etc. And then there'll be a sign-off at the end, hopefully, if I survive that long. Just a few house rules. Please understand this is not financial advice. This is me talking about my perspectives based on my analysis, my understanding of what's going on, but in no way does it constitute financial advice. I don't know individual circumstances. I'm not qualified to give financial advice. Don't take it as such. It is what it is. Secondly, please play nice in the chat room. We had a couple of shenanigans last time we ran one of these. No racist comments, please. Just keep it clean. There's plenty of brilliant people in the community here, and we can have a really good conversation, so let's not get distracted. We are moderating actively the stream as we go. This is at the 16th of July. If you're not watching live, this is as at today, the 16th. Things may have changed. We might have had a collapse. We might have had a property rebound. Who knows? I suspect probably more like a collapse than a rebound, but that's another story. If you want to get my attention, use the Walk the World, because there's a lot of activity on the stream, a lot of people making comments and conversation. I won't necessarily pick them all up. I will try. Last time there were lots more questions than I could get to, and it's probably going to be the same again, but we'll see how that goes. And so just now, quickly on, just so you're clear, this is my research universe. So basically, I'm talking from the point of view of data, and data is really important, particularly now. So essentially what data is giving me is the ability to be able to look at the industry, looking at our surveys, looking at other information that I've got, into our core market model, and all the information that comes out when I present the sessions, or when I put Skype up, or when I do anything else. It's all about my data sources. So it's about using my core market model, which includes my private data, it includes public data, and a bunch of other stuff. So 52,000 households at any one time, a lot of data in there, and of course quite a few clients around the world actually take that data and do their own analysis off the back of it. We chop it and slice it all different ways. We have a segmentation model, we have a geographic overlay, we have a property status segmentation as well. All of those things mean it's like a big Rubik cube. We can mess around with it. And that means that we can come up with some quite interesting comparisons of different things that are going on. Now, the first thing, this was the RBA minutes today. You may not have seen it yet, but I think it's highly significant. And I've just pulled out a couple of paragraphs. Essentially, they said, survey data indicates that the housing debt by higher income and middle-aged people, that's okay, tend to be more stable employment and have larger savings buffers. However, members recognise that a material share of household debt is held by lower income households, which generally have higher debt relative to their income. Household assets in aggregate are valued at 5 times, fair enough. Total assets exceed the value of debt for most households. Well, that's, I suppose, a relief. But here it is. Noting the high levels of household debt could affect economic outcomes. And this is the critical point, because it's not just individual households struggling, it's what happens in the broader economy because they're not spending at the shops, for example. Members noted that changes in interest rates will have a larger effect on disposable income for households with higher debt levels. But these households may be less inclined to borrow at times when interest rates fall. Who knows? Here's the point. They are really now focusing in on household debt, but they're also trying to play the old card, which is, the debt is actually spread to those able to service it. Now, I have to say that my analysis is actually looking rather different, because we now have a lot of debt sitting in more affluent households who've got multiple mortgages, who've got interest-only loans, who are leveraged up to the hilt. And therefore, it is not necessarily the case that those more affluent households are without difficulty. We'll come back to that a bit later, but that's really important. So there you go. Today's minutes, they recognise the problem. They've been saying this for the last couple of years, but the tone has sort of been lifted. By the way, they also said in the minutes today that they thought the next rate move will be up, but not immediately. So we'll come back to that too. Just by mortgage stress, this is what came out a couple of weeks ago. Mortgage stress has never been higher. It's now 30.2% of households with an owner-occupied mortgage are in mortgage stress. I look at mortgage stress in terms of cash in and cash out. If you want to learn more about mortgage stress, you can go and look at the debts are the debt pips squeaking post, which is up on YouTube, where I go into a painful amount of detail going into some of these more important details. But there is, I think, some quite interesting trends here. And notice also that the ratio of 190 debt to income, that's the RBA figure. That's never been higher too. So next one is the confidence index. So this has come out today. Household finance confidence on the blink, I should say, 89.7 now. So that measures how households are feeling about their finances. We're looking at income and expenditure and costs and all those things. Again, read the post for more detail or watch the video. But the critical thing is that there's a lot of people in a lot of pain. And you may have seen that we were quoted last week suggesting that if rates move up even a small amount, then there are going to be significant numbers of households who are going to be in difficulty. Well, the fact of the matter is that there's around 970,000 in stress at the moment. If rates go up as expected, that'll be 1 million households in stress. Not immediately defaulting, as the media decided to report it, but nevertheless, it's pretty significant. Just passing on to talk about building approvals. We're past the peak, pretty still high, but going down. We are seeing a lot of pain now in the construction sector, and that's very important. We'll come back to that as well. Auctions are way down. This is just the trend for Sydney and Melbourne, effectively a bit of a monthly average. If you want to know more about what we think about auction results and what's really going on, we did a post called Auction Results Under the Microscope, and that is... Somebody's asked me a question. I'll come back to that question. The data was, when I started collecting the data sufficiently to be able to actually do the analysis. So that's why I've got the information as far back as I have. So auction results, not necessarily a very good indication of what's really going on, is my point there. And then finally, just to say that there is a bank funding problem. The BBSW has come down slightly, the bank bill swap rate. That's the sort of the interbank rate. That's effectively giving us an indication of what banks are struggling with. 25 basis points, it was over 30 at one point. But here's the thing. There are big institutional investors from who were overseas investing in Australia, taking their funds back to the US, for example. And we're seeing some depositors now taking money out of the banks because the returns are so low. So effectively, banks have a funding problem, which means they've got to go to the markets more when the rates are higher. So that's why there is a problem in terms of trying to make the overall momentum in the banking system work appropriately at the right level with the right margins. At the moment, they are giving margin up, and they're also attracting or trying to attract new borrowers to keep the momentum up, which means that effectively they are stealing backbook margin effectively, which they've got to recover in due course. Okay, and then just finally, a few slides here, or a few pictures, just to say these are some of the most popular posts that we've had over the last month. John Adams and I, the economist John Adams, has done one on what we've called the $1 trillion iceberg, which looks at international debt. That's a really important subject. We've done one on the Australian debt bomb. That was our first joint one, and that went really well. It's got the highest number of hits I've ever had. It's worth watching if you've not seen it. We go into why we've got the debt problem and therefore what we can do about it. There was a couple of on mortgage stress, but 9 News, the one there on the right, was a very popular one because that was the first time that the mainstream media recently started reporting mortgage stress. And then there's a couple at the bottom, a couple of my favourite posts. The first is on the debt elastic. When is it going to actually ping back? And the other one specifically talking about bail-in and bail-out, because bail-out and bail-in becomes a very critical issue when we come back to financial resilience. And so, to financial resilience, the thing I want to sort of talk about here is the state of household finances. I'll talk about some of the near-term issues that rate represents, and then talk about some of the longer-term strategies, and then talk a little bit about the different scenarios. And if you want to know more about the way I think about scenarios, there's a post we did a little while ago called 4 Scenarios, None Good. It's still up to date, pretty much. But who knows precisely where it's going to end up. Okay, so now before I go on with financial resilience, let me just look back over the post and answer a few of the questions here. Do you think interest rates will rise over the 18-19? That's from Dennis. Yeah, so there's 2 things going on here. First is we definitely will see more interest rate rises in the US initially. The Fed's got probably 2 more plumbed in for this year. That's going to lift the international capital market rates. What happens locally is an interesting question, because effectively you might see a scenario where the Reserve Bank cuts rates as international funding costs force the banks to put their rates up because they're worried about what would happen if rates rose. On the other hand, Philip Lowe is also chair of a BIS committee that published a report a couple of weeks ago. And that committee report said essentially that it's important now to lift rates from their ultra-low levels because it's risking financial stability, and there are bunches of risks in the system when rates are so low. So there is going to be a bias towards lifting rates. But then, of course, the question is how sensitive are households here to where rates are going? And my view is that rates are very, very concerning. Even small increases will lift that to 970,000 households to 1 million, 1.2 million. And that's enough to create significant. Aussie dollar, somebody's asked. Yeah, good question. It's going to slide down. It's going to be close to 70 probably over the next little while. It's at 74 at the moment. If you go back over the last 9 months, you'll see it's been coming down quite steadily. Effectively, the economy here is being reassessed and revalued vis-a-vis the rest of the world as more people understand more of the risks, I think is probably the case. Now, somebody's come up and said, my theory is that low rates are forcing people to look to crypto. I think you're right, but there's a big question, right? So if you are in the situation where, for example, you have cash in the bank or you've got it in a property or you've sold the property, it's a really interesting question as to about what you do with it. And the fact is there are not many good options. Even I would say crypto is not necessarily a hugely good option. We'll talk about that a bit more in detail. Okay, let me see what else we've got. Yes, Peter said, I've noticed you're ruffling a few feathers on your work on debt, on future property valuations. No, I don't react really, because I am fundamentally driven by data, okay? I do have very good sources of data through my surveys and through the analysis that we do. And there's a lot of opinion out there supported by hot air and not a lot else. But if you've actually got the data to prove it, and I can prove, going into individual households and look at individual balance sheets and looking at how sensitive they are, that is a very powerful position to be in. And frankly, if you think about the poor data that is actually often shared by the banks back to the regulators to an extent are caught by not necessarily having a good full picture. The Reserve Bank is still quoting information from the survey that was done 3 years ago, which is way out of date now, the Hilda survey. That information is so out of date that it's probably not true. They're going to refresh it at some point, but the Reserve Bank isn't doing a huge amount to necessarily look at that, although I did say there was some new survey stuff. Haven't seen what that detail of that was. Also, APRA has done some additional research, that they said in their recent presentation. Wayne Byers said, don't know what that is, no disclosure on that, but data is important. So the short answer is, I actually think The data is powerful. And so somebody's said, Debbie, the RBA is basing that on ignorance or bad modelling. Probably. Who knows? I'm not sure whether they really want to know what's going on. There's a very strong message coming out from, if you like, official sources saying, don't scare the horses. Now, of course, you can make things a lot worse by essentially continuing to, discuss the downside. But the fact is, the data's there. I've shown it to you this evening. Mortgage stress, financial confidence, auction clearance rates, and all the home price stuff that I report on a weekly basis. So, to my mind, what we should be doing is recognising where we are rather than trying to argue that we don't have a problem in the first place. And then we can begin to strategise about it, because there are things that potentially could be done. But if we continue to actually believe that there isn't a problem in the first place, then we're going to end up in a rather difficult situation down the track. And I have to say there are significant parallels between what's going on here and what's going on in what went on in Ireland in 2006 and 2007. I did a video a few weeks ago drawing parallels between Ireland and here, and what was said before the correction that happened in Ireland, and what people are saying now, and there are horrible resonances between the two. The fact is, we have very high debt, we have a lot of households who are in difficulty. And to give you an idea, I survey households, right? And they tell me this. Firstly, about half of them have no real clear view of what their finances are like. So they actually don't keep budgets. They actually don't really understand. So you have to probe quite heavily to be able to get to understand how their financial situation is. We also ask them whether they feel that they're in mortgage stress. And there's a much smaller proportion of households who say that they think they're in mortgage stress than actually are when you look at it on a cash flow basis. So we measure money in, money out. What are all the things they're spending it on? What is all the money coming in? If there's a zero or under, then they're in stress. And the point about that stress is it builds and builds and builds because income growth is too low at the moment. Costs are going up, all the standard stuff from electricity costs and other fuel costs, as well as childcare costs, school fees, even healthcare costs, rates. All those things are going up. What that means is that essentially households find it more and more difficult to make those budgets work. Now, if they have got a budget, what we then look at it with them is, well, what you can do is then begin to actually make decisions. If you know what you're spending, make decisions. And at the moment, a lot of people are still not off first base. They don't have a budget. So my first observation of the night is, make sure you have a budget. I know that sounds a bit anal, but actually it's really critical, because if you don't know what you're spending, you can't make decisions about where you can trim and crimp and save. And, not necessarily everything is equally important. So that's the next point, is that households who are better with their budgets and begin to prioritise can actually deal with a few different things with regard to their status. And it gives them the opportunity then to make some decisions about, well, maybe I should not do that or not spend that, spend it on the really critical things. The other point there is that quite a few households, again, they get into difficulty, immediately reach for the credit card. And what we're seeing is significant concentration of debt around households with big mortgages. And that's one of the things that a lot of the official data doesn't get across yet, because we don't really have a good view of total household finances other than the DFA data, which actually does. So we can look at not just the mortgages, but we can also look at the other debt that they have too. And then the other trick, of course, is to then raid savings. And that's one of the reasons why the savings ratio is considerably lower than it used to be. And it's still dropping. Okay, just a quick look at the conversations. Ireland took a year for prices to really start falling. Correct. Yep, 2 or 3 years is typical. It was about 12 months later, then the custard hit the fan. Indeed, that's exactly right. This is not something which is going to happen like that. It's going to take a few months. And I've said consistently that I think 2019 will be the critical year when all of these things are beginning to coalesce. In fact, it's moving slightly faster because we have prices falling quicker than perhaps we originally expected. And we've also got the situation of interest rates rising faster because of what was happening in the US. So those things are probably going to keep it going. Okay. Oh yes, I'm sorry. Did I use the word anal? I'm terribly sorry, but it was, of course, only in regarding my ability to analyse. Okay. So, state of household finances. There are 2/3 of households that are absolutely fine. They've got big mortgages, they've got big incomes, and everything in the garden is pretty good. We've got 1/3 of households, that's more than 1 million households, who are completely under the gun at the moment. And interestingly, looking at the data that I published today, we also discovered that around 40% of households who've tried to get refinancing in the last 3 months were unable to get the refinancing they wanted. And that's because of the tighter lending criteria and the very granular analysis that's now being done by the banks. So one of the factors we've got to take into account in this scenario as we play it out is to what extent households with high debt levels are able to refinance. A lot of them can't. And the other group that's finding it difficult are the interest-only guys. A lot of those are more affluent, but again, they've got the same issues. With suddenly their interest-only loan is up for renewal, they can't get another interest-only loan because they don't fit the criteria anymore, and therefore what they're now doing is essentially dealing with the question of, what do I do? Do I sell? Do I get a principal interest loan and increase repayments by 40%? Can I afford that? Especially if the rental streams are also beginning to wilt a little bit. That's one of the things that we're actually seeing at the moment. Going to come back full screen now. Okay, so let me just have a quick look down the conversations. There's a few things. Okay, so there's the old conversation about physical assets, gold and what have you. And you may have seen the video we did with John the other day talking about the gold standard and what happens when you go off the gold standard. There is an issue with precious metals, particularly gold. Of course, there is the 1959 Act, which basically gives the government the ability to effectively buy back gold at any price they determine at any point. So that's something that a lot of people don't know. So gold is not necessarily a perfect answer. And of course, the thing about gold is you've got to store it. And you've got to also bear in mind that nobody quite knows what the price of gold will be. It's actually been sliding relatively recently. So that's an interesting observation. Silver, maybe, I think John Adams the other day said, well, maybe silver is actually the particular precious metal that's actually got more of a history of actually being that safe harbour, or indeed the supporting the currency. Now let's have another look here. The 1959 Banking Act. Thank you. Yep, that's exactly right. The alternative has given me the Act. Okay, net foreign debt. Yeah, well, did you see the video that we did on net foreign debt? It is huge. $1 trillion is owed by Australian corporates and companies overseas. That's a big number. And of course, the interest charges on that will go up as the international rates rise. So what that means is that effectively that international debt level is scarily high, and we're right up there around the world. But of course, many other countries also have a lot of debt too, and the amount of debt globally is something like $237 trillion out there around the world. It's never been higher, pretty much. Yes, it is. Most Nat has asked, is that $1 trillion mainly in the US dollars? A lot of it is, because the US market is by far the biggest and most liquid market. So it's an interesting question, but yes, that's true. There are other countries there too. Greg Martin says, yes, Martin, many governments hold enormous gold reserves, and it's to their advantage to get a great deal if we go back to goods. And yeah, fair point. We have a certain amount of gold, the RBA does, but it's not a very large amount. It's not grown very much in recent times. So it actually is rather disconnected from, the printing money activity that's been going on for years and years and years. And that was the point about the video I did with John yesterday, which was to say, well, you have a $5 note, but what makes that note worth $5? And the answer is it's sort of confidence, and that means that there's ability to move it and change it. Okay, bail-in. Okay, let's talk about that a little bit now, because there's been a few people asking about bail-in. Let me just try and give you the sort of the story here. So if you assume that basically, I've got money and I'm not going to put it in property because I think property is going to slide. I'm not necessarily going to put it into silver or gold or those things. Maybe I should put it in the banks. At least in the banks it's safe, right? There's a government guarantee. So it's not quite that simple. There's two things to understand. The first is the government guarantee is not activated until it is. In other words, it says that there is one, but it's not activated at the moment. It's $250,000 per set of accounts at an individual bank. So you can spread it around. You can have multiple banks up to 250K. If you have 4 or 5 accounts, only the total is 250K. So you can't have it multiplied by sort of 4 or 5 times. But that guarantee is not active until the government activates it. Okay, so at the moment, whilst there is the promise of a guarantee, there is no deposit guarantee. That's the first point to understand. A lot of people are surprised by that because they sort of assume that the guarantee was actually in place. The other thing to say is you be careful because not all banks are covered. You've got to be an Australian bank with an Australian license. Some overseas outliers of international banks may not necessarily be covered. It's worth checking that. The other thing then is bail-in. Okay, now, the theory around the world is this, that we had a hell of a bumpy ride post the GFC when effectively governments ended up bailing out banks, in the UK and in Ireland and other places too. So they basically gave public money, publicised the bank and allowed it to continue. That's because they needed liquidity and they needed support. But that was a huge, huge cost on those economies. And so the sort of the official line is we can't do that again. We need a different strategy to be able to deal with banks as they get into difficulty. And so that then takes us to, well, what are the alternatives? So the first thing is you try and create what's called a living will for banks. In other words, there's actually some thought about what might need to be done before it happens, so that there's actually some plans that can be activated, first point. The second is that they've lifted capital ratios, so effectively the banks have more capital to support them as they go forward. But thirdly, there's a thing called bail-in, and bail-in basically allows certain asset classes that are actually provided by investors to those banks to be captured and used by the banks in time of pain. And a lot of those would be hybrids and bonds and those sorts of things, which are clearly designed to allow the bank to be able to get the benefit of them, but also use them in the case of the bail-in. But the legislation, when it went through Parliament, was very vague and it included the term other instruments. And the big debate is other instruments sufficiently well defined to avoid bank deposits? Or is there a theoretical risk that in a time of crisis, when people are trying to struggle to deal with, say, multiple bank failures, would there be a temptation to grab those deposits before the deposit guarantee scheme is actually activated? Now, in New Zealand, they actually have a very clear and a well publicly articulated strategy which says deposits are included in the bail-in. And the whole idea is there that the deposits are taken, used to help prop up the bank, and a proportion of dividend comes back then to the depositors, but you don't have to get all of it back. Now, in Australia, that legislation went through. It was through on the nod, frankly. There wasn't really a good discussion in Parliament about it. It was around the APRA Act. And basically, it says that APRA has the ability to focus on managing a particular bank through its crises for the benefit of depositors. And actually, that means that the argument then comes down to, what's the difference between a deposit and a depositor? Could you actually protect depositors by actually bailing in deposits? Now, Wayne Byres has said on several occasions, and the Treasury said on several occasions, the legislation is not designed to bail in deposits. There's no intention of doing it. But that legislation still stands. The vagaries are there, and no one, I think, is totally convinced, and I'm certainly not totally convinced, that the bail-in of deposits is not necessarily a phenomenon that could happen under circumstances. I think it would have to be multiple bank failures, And in a way, that's the point. So most of the things that are being thought about would be a single point of failure. But what happened if we had 3, 4, 5 banks all going over at the same time? At that point, I think bail-in is certainly worth thinking about. So the final thing to say about bail-in is that the New Zealand government, the Reserve Bank in New Zealand said, depositors need to make a risk assessment of different banks and their likelihood. In other words, not all banks are equal. But my argument is, how on earth do we in Australia have the information to make a decision about whether Bank 1 or Bank 2 or Bank 3 or Bank 4 is less or more risky from a bail-in perspective? So that whole issue is up in the air, open, vague, and therefore, not surprisingly, subject to a whole lot of discussion. Okay, hope that's helped a bit on the bail-in. It's one of the critical questions I keep getting asked. Bail-in is, one of those perennials, but it is a real risk, I think. And so, if you think that things are going to be relatively ordered and there's going to be maybe the odd failure and prices are, property prices are going to slide and it's not going to be too bad, you probably would do quite well by spreading your 250Ks, if you've got that amount of money around, across the banking system. But just bear in mind the bail-in thing. Okay. Will citizens' deposits that are grabbed by the banks ever be paid back to the depositor? Can we kiss goodbye to our money? Wayne, I suspect what will happen is that there will be a dividend. In other words, they will take a proportion of it. That's pretty much what the New Zealand model is like. So, if you had $100, they might nick it and then give you back 95 or something. So, who knows? Isn't the deposit guarantee limited? Yeah, there are caps on it. That's correct. There are caps on it. So it's not unlimited. And in fact, there are 2 versions of the guarantee. There's one up to 250K. The banks also have the ability to activate one above $1 million, but no bank has done that. They have to pay more for it. Okay. New upper rule coming in that all banks can only lend 4 times income. Anthony, that's not quite true. What APRA has said is they're happy to release the controls on lending, but only when the lenders have demonstrated that they've got good, firm controls on their serviceability criteria. So if you go back a few years, there was almost no focus on serviceability, frankly. You could get 6 times, 7 times your income by way of a loan, and the assumption was, well, prices are always going to go up, so there's no real risk to the bank. There might be risk to the household, but that's another story. Now, of course, the Royal Commission and the other things have demonstrated the fact that there is a huge amount of issues with regard to many people's loans, and in fact, many people have got unsuitable loans, which begs the question then what happens if they are unsuitable. We'll maybe come back to that. So the thing about that is that APRA is now beginning to force the banks to be more rigorous about their serviceability. Now, the way that's translating in practice is that lenders at the moment are asking for much more painful detail by category of expenditure. CBA's got 11, I think, and some of the others have a similar number. So the whole point about that is that what they're trying to do is to limit the risks by showing that they've gone through the process, and they'll get the borrower to sign on the dotted line to say that those expenses are correct, accurate, and that's the basis on which the bank has actually made the assessment. Now, I've got 2 points. Firstly, I said right at the start, about half of households have no idea what they spend. They've got no real firm budget. So in many cases, they'll be taking an educated guess at very best as to how much they've actually got and what are they spending and those sorts of things. So those expense categories will be fuzzy at the best of times. Second point is that by forcing that degree of transparency out and getting the borrower to sign on the dotted line, the bank is transferring risk. Effectively, what they're doing is making sure that the risk is back on the borrower rather than the bank, so they can avoid any accusation of the loan was not unsuitable, because they can argue, see, this is what the borrower said. So there is an interesting thing going on here. Now, I don't know to what extent APRA is going to test what the banks are doing, but I don't think it's going to be 4 times. I think it might be, higher than that, 4.5, 6. Some banks have already cut it back to 6. I think it will go lower. The UK, they've got a rule that says 4.5 times for most loans with a small proportion higher on a sort of flexible basis. So the Bank of England is more aware of that situation than we are here. Okay, let me just go back over the... Okay. Putting money in the bank makes us unsecured creditors to the bank immediately on deposit. Correct. When banks went bust in the 1890s, it took decades for people to get their deposits back. True. That's exactly right. With respect to bank bail-ins, when would they likely to be enacted? House prices falls of 30%. Look, the question is, how will this all play out? So we're talking about financial resilience, right? And so part of financial resilience is what can households do? So some of that is to do with managing their expense base better and prioritising paying off high interest debt first and those sorts of things. But more broadly, there are significant risks in the portfolio from the bank's point of view. And the question is, do they understand those risks or not? Now, my theory is this. A lot of the risk models the banks used were built in the early 2000s when income growth was very strong. And the story was that you might stretch yourself for a year or two, but it would actually all get better. Simply because over time you would be able to see your income growth covering the costs and you'd be fine. This time we have no income growth. Income is growing at around 2%, same as inflation. And in fact, my household surveys and my financial confidence index today highlighted the problem of no income growth. A lot of households are basically seeing their incomes flat or falling in real terms while their costs are going up and the cost of the mortgage going up. So it doesn't necessarily take a 30% fall in house prices to create the difficulties. It only comes to two things. Can households continue to service their mortgages on an ongoing basis? Yes or no? And we know that there's close to 1 million who are right on the edge now, and therefore if anything moves them up, it could actually be a significant issue. And we also know that the banks are relying on the equity, in other words, the difference between the loan and the value of the property. Now, the average loan-to-value ratio in Australia varies, of course, by different segments and different types of people, but it's actually quite high. And there are quite a few people who have the loan-to-value ratio of about 79. It's interesting because that's because at 80 you need lender's mortgage insurance. So a lot of people go up to the 79 and sort of are at that level. There's a big hike in there if you look at the data. Now, that means that with a 20% fall in home prices, there will be a very significant proportion of households who would have no equity. And if the bank, therefore, was required to liquidate the property, the chances are that there would be nothing left for the borrower in terms of equity. The question is, would there be enough for the bank? And of course, if a lot of people are liquidating at the same time, that's when prices go further. So at 35%, that will be significantly below the sort of amount that will be required to be able to keep the bank's asset on book. They'd have to write it down. Now, this takes me to the APRA stress test. The results came out last week. APRA basically said, let's do a scenario test. Let's assume that unemployment rises to 11%. Let's assume that prices fall significantly. Let's assume that the funding overseas stops. So basically, the banks can't get more overseas funding. And they ran a whole bunch of scenarios. And basically, at the end of the day, we have no problem at all. The banks will be able to cope, no problem. Even in that really adverse scenario, everything is fine. And they sort of worked out that there'd be a $40 billion hole in the bank's books, but not sufficient to create a problem. They've got more than enough capital to cover it. Now, the problem I've got with that is that that was a very high-level summary of what they did, and we don't know the detail because it's never been published. There's no disclosure down to the individual bank level, unlike in the US, where they actually go bank by bank by bank and give us full information. But the other worrying thing is that LF Economics took that same set of scenarios and ran their calculations based on the data that Westpac disclosed to the Royal Commission with regard to their mortgage portfolios. And they come out with a number more like $290 billion loss rather than the $40 billion, which is a big number. I did the same calculations, but not using the Westpac data, but using my household survey data. And I came up with 310 billion, which is more than the amount of capital that's sitting in the banks. So I have a theory that the stress testing may not be as rigorous as perhaps people might think it is. And because it's not really disclosed in any great detail, and because there's no information about individual banks, my own view is you take it with a bit of a pinch of salt. I think it was done more for the window dressing than for reality. There is a lot more to be done to really stress. Okay, let me just come back to the chat. Are companies with deposits? No, it's the personal sector, I think you'll find, not corporate deposits, nor indeed are superannuation assets covered, because it's not an individual. A superannuation entity is effectively a corporate structure. So I think you'll find it, could be wrong, but I believe that's the case. It's individuals. Okay, what else? So they can't insure an event as big as that. Yeah, it's a facade. Well, you see, I think it is a bit. I think that there's a confidence thing here, right? The fact is that you can talk yourself into a crisis. If everybody says it's going to be terrible, then you can absolutely do that. But you can also lull yourself into a full sense of security, and that's what I think the regulators in Australia have done. And actually, households have been party to it too, because effectively they've had easy credit for a long time. The banks have been very willing to lend. And what it means is that we've got this massive build-up of debt in the system. And remember, and I keep saying this, debt has to be repaid. You can't go, it doesn't just disappear unless there's a major reset of some sort. And we may talk about that as we come towards the end of this session. So the point is this, that there is a significant set of risks in the system at the moment. And then going back to what the Reserve Bank said, not only is there direct risks around the banks and around households and their household finances, but as households get more and more caught with this debt, they withdraw their spending more and more. And that's why retail spending is not very strong in my view. And that's why the savings ratio is going down, because effectively households just don't have capacity to spend. And it's that economic impact which I think is the most significant and important one. Overlay that with potentially the construction sector, who will also be hit. And remember that if you add the construction sector and you add the real estate sector, and all of that together, property, real estate, construction, it's about a third of the total economy in Australia. So what that tells me is that if that whole thing begins to actually wobble, not only do you have a lack of support from the household sector and their consumption, because that was what was driving the Reserve Bank for a long, long time, to get households to spend more, but also you've got this massive overhang in the construction, property and finance sector. Remember that 63% of all lending for the banks in Australia relate to mortgages. That's higher than almost anywhere else around the world. It was higher than where it was in the US, for example, or the UK, when they had the GFC. So there's a significant question about our concentration in property. And my argument has been for a long time, 4 or 5 years, you can go back and look on the blog, I've been saying for a long time, what we've done is we've actually boxed ourselves into a corner thanks to poor public policy from the Reserve Bank and from APRA and from the government, inflating the economy, essentially driving property, creating loans out of nowhere to be able to actually continue to lift GDP. But we've now got this huge overhang. And the question now is, how do we navigate that going forward? And that takes us to the longer term strategies, right? Because effectively, going forward, can we manage this without a bubble busting in some way? And the debt bomb that John Adams and I did highlighted the fact that there's almost been no situation where this amount of debt and this amount of difficulty has actually gone without there being a bust. And so scenario one is there's going to be a significant bust at some time. Nobody quite knows the timing. Could be a few months, could be 2 or 3 years, but all of the hallmarks are there. If you lay down all of the issues that we saw in the US or in Ireland and compare them with what we've got here, we've got the same scenarios going on. Or is there an ability to get proactive and begin to think about how to start managing some of this now? Well, there are a few politicians who are worrying about this and thinking about what the alternatives may be. But at the moment, I have to say that most of the political mainstream is still on the property's great, not going to fall very far, if at all, and everything is in the garden is wonderful. The real estate sector is still saying it's a great time to buy. First-time buyers, come in now. My argument is, first-time buyers, wait. Prices will get cheaper. It isn't a good time to buy at the moment. And if you're an investor, if you look at the rental returns and if you look at the risks in terms of interest only versus not, it's not looking very flash. Remember that if Labour were to get in, they've also said that they're going to crimp negative gearing, which will be another downside risk to the market. So there's a whole bunch of reasons why I personally believe that there is going to be a correction. There are some things that could be done, but I suspect that there probably won't be. And in one of my other videos, I talked about, well, what are the sort of the plan A and plan Bs? Well, there is a thing called the Chicago plan, which basically then resets loans and forgives loans. There are people suggesting that there should be jubilees. In other words, you let people off, but there's a moral hazard to do that. The fact is, we've got this massive debt burden, and at the moment, there's no easy way out. Okay, now, people are now, Harmony, for example, has said, what about Bitcoin? Yeah, Bitcoin can't be frozen or seized, unlike the fiat currencies. Yeah, true. And there are many people who believe that the cryptocurrencies are the perfect way out of this hole, insofar that no one is in control of crypto, and it's beyond the realm of central banks and governments to actually mess with it. Now, 2 points. Firstly, there are attempts around a number of central banks to begin to get their arms more around this. They're even talking about central bank digital currencies, so we'll see that. But the other is that Bitcoin itself is a relatively unstable thing. You don't really know what the price is. Is it fully functioning money? It probably isn't really, because if you look through the definitions of what makes money, Bitcoin doesn't necessarily tick the box. So my own view of Bitcoin is there is something there in terms of the blockchain technologies and the ability to actually have distributed ledgers. But the Bitcoin itself and the pricing of Bitcoin is a concern. It really is a speculative thing. Now, you might decide that in the current environment, if gold is a problem because they might nick it, and if deposits doesn't work, well, maybe crypto is a way to go. But it's actually, I think, pretty risky. And personally, I'm not convinced that it is that silver bullet, although many people have said that it could be. So go through the list, right? You can say, okay, property is a risk, downside risk significant. I think prices in Sydney will probably be 20% lower before we finish. It could go further. Melbourne will be the same. Brisbane will correct a little bit. Perth has already corrected. There's a bit more to go from there. Smaller states, forget it. Look, all this hype about Adelaide and Hobart, it's not really relevant. It's such a small market. It doesn't really make much difference. The volume is in the major eastern states, and that's where the action will be. I think prices will continue to fall. If you've got cash around, deposits is one angle, but as I said, there is issue with bail-in. You can think about commodities, but there are some issues there. You can think about crypto, and go down the list. There is no simple silver bullet to build financial resilience at the moment. Which way you go will be determined, I think, predominantly by what you think the scenario is most likely to be. Is it going to be a mild correction? Is it going to be minor? In which case, the standard strategies that people are adopting at the moment will work. If it's more a crisis, a bit like the UK or Ireland, then effectively the banking system itself will be creaking at the seams. We'll probably get some sort of bail-in from as well as a bail-out from the government. I suspect that the government will end up, through the RBA, purchasing assets from the banks to be able to support their liquidity, particularly if the overseas markets get frozen as a result of it. And so my point is that what you decide to do in terms of financial resilience is predominantly going to be determined by your view on your scenarios and where those are going. Now, I can't make a decision for you as to what you think the right scenario is. What I can do, and what I am doing with the YouTube channel and with the DFA blog, is to provide you with information to be able to get you as informed as possible, to be able to make the best decisions that you can based on what's happening, right? So through the Property Imperative Weekly, you'll get an update on what's going on. Through my other videos and my other sort of sessions that I run, it's all about education, education, education. Because there is no simple answer. There is no one who knows precisely how this is going to play out. And to be honest, that level of uncertainty is part of the problem. Okay, let's see what else we've got in a lot of... Yep, you're right. And Debbie said it'll be a political decision rather than a financial one. It will. At the end of the day, a lot of these decisions are made on a political basis. The Council of Financial Regulators, right, is the entity that sits between the RBA, the Treasury, ASIC, and APRA, and ACCC is all there as well. So that is the entity that effectively is charged with trying to manage this. Now, of course, we don't get any information about the Council of Financial Regulators. There are no minutes published. There's no information. But it's interesting that quite often one of the other regulators will say the financial regulator decided or did this. I think there should be more transparency about the way that the financial regulator system works, and the financial council regulators, to my mind, the Council of Financial Regulators should be more transparent, because essentially that's where politics and the economics and the Reserve Bank and APRA and financial stability all come together. And yet, of course, we know nothing about what goes on there. We just see little manifestations of pieces of decisions taken, and with a very large pinch of, it'll be fine, guys, don't worry, we're looking after it. You know, we made the perfect decisions, despite the fact that APRA was very late to the party when it came to the issues about loan quality. ASIC was more ahead of them than APRA. That for a long time, the Reserve Bank refused to accept there was any issues with regard to household debt until we got a new government, and then suddenly there was a discussion about household debt. And even the Treasury, I think, frankly, the Treasury is very, very bullish in its own predictions and estimates now. If you look at the the scenario over the next few years, some of those in terms of wages growth, some of those in terms of GDP growth, look to me to be quite courageous. And so there's a political dimension to this which probably moves us beyond the economics. Okay, what else have we got? So if banks start looking wobbly, time to pull your money out. Well, that's an interesting question. So I did a video a little while ago when I actually played some of the videos from the UK when Northern Rock failed. And there were queues of people down the street trying to get their deposits out. And the government then came out and said, we'll guarantee the bank, we'll give them money. And there was a very famous reporter in the UK who stood out in front of one of these banks and said, the government's given this guarantee, everything is fine, there's no risk. And next day, more people hurtled down to try and get their money out. It's a confidence thing, right? So the question is, at the moment our banking system is strong, it's resilient, we've got lots of bank with a lot of capital, so I don't think there's an immediate risk. The question is, down the track, if these things play out, these things could move quite quickly. So I think at the moment it's watch. Watch the data. Watch for the signs. Because it will take some time for this all to evolve. And there are things that can be done now, as I said earlier on, in terms of financial resilience. But there are also limitations to what can be achieved, I think. Okay. Yep, so somebody else has asked about the 20 billion per ADR. Yeah, there is a limit, I believe. I've had other people confirm that. The need to talk about bail-in shows there is a concern amongst consumers. I agree, Nobby, you're correct. There is a significant issue. Now, as I go around talking to people, there is a lot of discussion about Glass-Steagall and about the separation of the sporty end of banking and derivatives and all those things from the rest of banking. And there's a lot of concern about bail-ins. I'm very concerned that the authorities don't seem to be wanting to come up and answer those queries and concerns. And I've said to people they should really be talking to their MPs and writing to their MPs and harassing their MPs to talk about Glass-Steagall and to talk about bail-in. Because at the moment, we're sort of shuffling towards an uncertain future, and a lot of those factors are there and nobody wants to talk about them. Well, my view is that there is a significant reason to actually want to have a discussion now. Now, somebody asked me about Glass-Steagall. Let me just quickly cover that. There is a very significant derivatives risk to the banks in Australia. Those derivatives are, particularly sensitive to what happens with the international markets and those things. Very large numbers are involved, and about 40 trillion, I think, last time I looked. And that will be enough to potentially swamp the banks. So if you've got a bank that's got a whole derivative set of activity and also the retail bank together, effectively the derivatives could go down and that would swamp the whole bank. Now, Glass-Steagall is trying to separate those. There is merit in that. But it's also very late to do it, because actually it won't solve our debt problem, because the debts around mortgages in particular would actually reside in the good bank, not the speculative bank. So even if you implemented Glass-Steagall, it is not going to solve our debt problem. So we have to have a strategy around how to deal with debt, separate from Glass-Steagall. So I think Glass-Steagall is good, and I've written various papers on that and made some videos on it. Necessary but not sufficient to solve our problem. The debt is the problem. And the question now is, what do we do about that debt? Do we hopefully muddle through, as we've been doing for a generation or two, 30 years pretty much? Or do we actually find a different path? And that really, to my mind, becomes the important question going forward. Okay, now it's 8:57, we're nearly an hour. Goodness me, I'm running out of steam quite quickly, so let me just have a look and see whether any... let's not talk about crypto, please. No, fair enough. Okay, I'm not going to talk about crypto. I'm with a community bank, says Donna. Do you think they take less risks? Yes, I think that's right. I think that some of the smaller organisations, firstly, have higher capital ratios to start with. Secondly, they don't have such a complicated business. And thirdly, they are smaller and therefore they can manage their business more discreetly. It's not so complex. So my own sort of perspective is that some of the community banks and some of the smaller organisations are actually potentially more, more attractive. I gave a talk a few months ago to the peak body of effectively the community banks, and said to them they had a huge opportunity to differentiate themselves from the major banks and some of the other big players by effectively showing that they do things differently, have different culture and different products and those sorts of things. The trouble is that community banks are slowly drifting more and more towards the behaviour of the mainstream banks. So at the moment, I'm not sure that necessarily they're steering the right path, but I think, right, the risks are probably a bit lower. Greg Martin says, yes, debt is the problem, but it's not just Oz debt, it's global debt. Agreed. Greg, I absolutely agree with you. Yes, the debt issue is huge around the world, and it's almost too big to manage. That's really the problem. Okay. What's stopping high home prices moving into consumer good prices? Good question. Well, actually, if you look at consumer goods these days, relative to where it was, you can get a lot more for your money. So, and that's partly because more of it's manufactured offshore and brought into Australia. The thing I'd be looking at there is consumer credit as well. There's a significant growth in some aspects of consumer credit, particularly vehicle finance and others as well. So there are people who are still wanting to have the lifestyle and effectively put it on more on credit. And in fact, in my household surveys, there are a number of people who simply say, look, I'm never going to pay this debt off. I'm just going to keep it bouncing along. I'm going to sort of switch it from credit card A to credit card B. I know I'm paying interest, I can just about, but effectively they've got no intention of ever selling, ever paying the debt off. That's a really interesting observation, and frankly concerns me. Maybe it's my age, but to my mind, having debt around your neck for your whole life, is a nightmare as far as I'm concerned. But maybe you've got a different view. Okay. The central banks of the world hit file print dollar, creating cheap credit, thus leading to inflated prices and high debt. Got to blame that 2007 GFC. Neil, you're right. We didn't solve 2007 GFC. We haven't solved it. Actually, all we've done is kick the can firmly down the road. Same things are all happening again. Even in Ireland, where they had the massive crash, you've now got precisely the same issues going on again with house prices rising and with debt rising. We haven't learned the lesson. And in a way, the longer we leave it, the bigger the debt balloon goes. Look at our debt bomb video if you want more on that. It is an amazing story of stupidity in a way. But there you go. Hard to see a way out without, as I say, either it bursting or effectively the debt is in some way reset. Okay. Somebody said I'm old. Yes, I know. I've been around a long time. I've done a lot of banking stuff in my career and a lot of other things. Okay, so as we come to the end of this this session, I want to leave you with just a couple of questions. Question one is, what would you like to sort of delve into more going forward? So do you think that there is actually merit in, for example, going into more detail about the way the capital markets work and the different products and derivatives? I get quite a lot of questions around that. Or do you think you want to look more on the consumer debt side? I would like to know whether there are particular things that you'd like me to delve further into. I know that there's a very strong interest in regional home prices and regional economies, so we're going to do something on that. I know that there's a lot of interest also in some of the alternative strategies, and I've promised I'll come back on the Chicago plan at some point and go into more detail on that. And I'm going to update my 4 scenarios because actually we're moving into the future quicker than I perhaps expected. So feel free to make suggestions either on the stream now or subsequent, because I'm really interested. I do take account of what people say, and I do try and shape the content accordingly. I'm also trying to get some other guests on because I actually think the guests give a different perspective. I don't necessarily agree, by the way, with the guests that I interview, but it's a different perspective, and I think that's quite powerful. Okay, so as we come into the last 2 or 3 minutes, is there a ceiling for house prices in the economy as a multiple of income? It seems impossible for capital growth to come from anywhere over the next 10 years. Well, yeah. Oh, somebody said, do all of the above. Oh, God. More work. Okay. Well, let me just say this. If you really want me to do more of this stuff, then please consider making a donation via Patreon, because what I'm doing, I'm spending more and more of my time on the social media content and that compared with the rest of the business. And I've now got more than 35, 36, 37 patrons who actually are helping me to fund the research that I do. It is a genuine plea and a request. The more that I can actually be freed up from the other stuff that I do, the more I can put effort into providing these sorts of videos and more instructions. So very, very important. Now, somebody asked me, went off on a tangent then. Is there a ceiling for house prices? Yeah, here's the thing, Marty Pants. I hope they got it right. It's late in the night. Yeah, okay. The way that it works at the moment is that there is no limit to the amount of debt that can be created. Debt can be created out of nothing. It's the biggest thing to understand about the way that banks create debt. It's just a book entry. And the old theory was you start by taking deposits and then you lend that money out to loans, and that meant that the deposits and the ability to get deposits limited the amount that you could spend in terms of lending. No, it's not like that anymore. You can create a loan out of thin air by creating a book entry. That money then comes into existence, and it can go to support a deposit account, or it can support property, etc. And the more that you can create that debt, that balloon, the more you inflate asset prices, which is what has been going on. And essentially, there's no end to the point at which people are unable to repay those loans. And so the theory of money, which we touched on with John in terms of fiat currency versus backed by a central value source, gold or silver, and this theory that actually loans appear out of nowhere are actually the two pillars that are actually rather heretical, okay, compared with mainstream economics. And yet, if you think about it, it's blooming obvious, because the more that you inflate loans, the more the house prices can go up, and there's no theoretical end to that process until the debt bubble bursts. Okay, I'm just going to quickly look down as we come to the end of the session today. Mr. Rogers said, I think this bubble will proceed unusually fast compared to Ireland and the USA, simply because the information is shared more widely and sentiment changes faster. Yes, I agree, actually. And the speed at which it's changing is remarkable. If you go back 3 months, I was talking to somebody earlier on today in one of the investment banks, and we compared notes about 3 or 4 months ago, and we were sort of saying it's going to be 18 months to 2 years. And we both said today, gee, it's fast. It's moving really, really fast. So I think that we've got to watch and wait and listen and learn over the next 6 months. I think November will be a critical test point. If, in fact, prices begin to move up again in November, maybe we'll escape the worst. But I have a feeling that by then we will see the writing on the wall. So please keep watching. Please, if you like what you've seen here today, like the post, share it. Please pass the information that we produce here as far as you can, because the more people who actually come and look at it, the more we're able to create more. The monetization process helps as well. I really appreciate all your support and your enthusiasm and the good-natured banter on the chat tonight. Terrific. Thanks very much for spending an hour or so with me. We will do another one of these again. I'm not quite sure how frequently, but we will do some more because I quite like the sort of the immediate interaction. And yeah, somebody said, wouldn't it be funny if the APRA and the RBA were a couple of Patreon supporters? Yeah, in your dreams. I'm not sure that I'm their favourite character. So thank you very much for tonight. Thank you very much for spending the time with me. And we'll talk again, hopefully quite soon. And take care, have a good evening, and I'll see you next time. This is Martin North from Digital Finance Analytics, signing off. Cheerio.